I'm going to try and spend very little time talking about my background, medium amount of time about the company, and save as much time as possible for the last section, mistakes and lessons learned. I was sitting in the back earlier, and I love because I could see everybody's computer screens, and there were like 30 people writing code, you know, in the middle of a presentation. Like everybody's fired up, working on really exciting stuff here. So the energy is super exciting. I imagine there are a lot of founders or aspiring founders in the audience. So that's super exciting. It's a really high energy place. So as Tara said, I am Dutch, but I was born in Japan and I grew up in Singapore. So really I have no idea where I'm from. I think I'm what you would call a third culture kid, which is the way you would describe somebody who's just a little bit confused about their descent. My first job was in London, working for Goldman Sachs on the trading floor, but I was in a team that invested in private companies, growth stage startups, high growth technology companies. So that's not actually me, by the way. So where I sat, my job was to be a human API, and that might make sense to some of you. To explain it to the rest of you, you know, Goldman Sachs, Morgan Stanley, these banks, they hire analysts like me, fresh out of school, to just do a bunch of very manual number crunching. You know, you're living in a spreadsheet all day long, finding data from different sources and keeping it up to date. It's very unglamorous. It's a very manual job. Most of my days started on Google and ended in a spreadsheet. And then my managing director would say, "Nice work." And then the next day he'd say, "Can you update that spreadsheet?" So I'd go back to Google and find the data point again and update that spreadsheet. So did that for 4 years and moved to the United States in 2011 to get my MBA at Stanford. And I'd like to say that it all immediately clicked for me. Let's write software to solve this solution. But it didn't, because I didn't have an engineering background. I had a business background. So it took meeting some really smart people in Stanford's engineering school, where over beers, a lot of cups of coffee and lunches, we realized that I had the problem, and some of these friends I had made, they had the solution. There were ways to automate that very manual, tedious labor that I'd gone through every day for 4 years. So that brought us to founding DataFox 2.5 years ago, just as I was graduating in 2013. The idea was to write scripts and algorithms that go out over vast public sources, news articles, blog posts, companies' websites, Twitter, Facebook, job postings, all over the place. Find references to companies, put that all in one place, so that that spreadsheet that I used to have to keep up to date manually, that it would stay up to date automatically. That was the idea. And fast forward to today, we have a database of almost 1 million companies that stays up to date overnight, 24 hours a day. And we sell access to that database as a subscription to people who work in finance, like me formerly, but also people working in sales, in commercial real estate, in law, in marketing. Anyone whose job is to go find information about other businesses, about information about sectors. We give them access to this information, and we take a lot of the pain out of their jobs. So today we're 21 people in a little office here in Soma, 22 actually starting Monday, and it's really exciting. There was a question earlier about building a team here. It's one of the things I've enjoyed most, and I can speak more to that in a little bit. This is what the website looks like when you land there, datafox.co, so you can see how we position it. It's a way to prospect, to find businesses, to track, to keep all that information about those businesses up to date, and to manage your pipeline, to figure out where you should be spending your time. So let me walk you through one example. Let's say you are a banker and you hear about this company DoorDash. They deliver food to your doorstep. It's like Grubhub, but better. And you want to find information about DoorDash. It's a high growth tech company. So you Google it and you find their website. Not going to learn a lot that way. The DataFox profile has these scripts that go out over vast public sources, put all this information in one place, show you this profile on DataFox that's much richer, and also how it compares to other companies in web traffic, social following. For different companies, different metrics matter, and we make sure all that information is available. Now let's say DoorDash isn't looking for a banker, but you've taken a view that, hey, this food delivery thing, this is going to take off. I don't know if it's, I've heard about Postmates, I've heard about Spoon Rocket. There are other companies that I think could be huge opportunities to either invest in or advise. So how do you find all the food delivery companies out there? You go back to Google, right? And you type in food delivery companies, and maybe you find 5 or 6 or 7. If you do that search on DataFox, we have the list already prepared for you. How do we do this? We look at how companies describe themselves. We look at how companies are co-mentioned in the news together. So if there's a news article about DoorDash, and the journalist in the last paragraph wrote, DoorDash competes with Spoon Rocket and these other companies. We identify those companies. So we have this list ready-made, being updated around the clock. And where it gets interesting is you can also visualize those relationships. So this is what that same list looks like, but now as a cluster. And now you can click on other companies to see how the broader universe relates to DoorDash. Who are their future competitors, their future acquirers? And you know, creating this would have taken a day as a banker to actually get that list of 20 companies, put that all in a visualization. So this is where the time savings really come to bear. The most magical experience that I think we currently deliver to our customers is around what we call sales triggers. So fundamentally, what these bankers and these people in sales and marketing are trying to do is they're trying to figure out which company to go contact. But as I'm sure many of you have experienced, the world is a very spammy place nowadays. We all receive how many sales and marketing emails a day? And how many of those do you actually respond to? How many times do you actually respond to a sales email and say, yes, I would love to buy that product or that service that you're pitching to me right now? The reason we don't do that is because people are rarely reaching out to us at the right time. So a really good sales rep or a really good banker, they look for these sales triggers, something that's happened around the company that makes it the right time to reach out, that enhances the likelihood that the person you're reaching out to might actually be interested in what you're selling them. And so what you see on screen here is one of the email alerts that we send out. So if you've said you're interested in DoorDash, you're interested in food delivery companies, and maybe 30 other sectors, because we're crawling the internet, because we're looking for all these sales triggers, you get an email in the morning or in your Saturday morning briefing saying, we identified a few of these events that may make these companies good companies for you to reach out to right now. This all falls in a theme that I think you'll be hearing a lot of in the next few years. It's called account-based marketing, ABM. In a nutshell, what that means is that instead of spamming a lot of people with your service or your idea, you're extremely targeted about which account, which company to reach out to and why. You'll hear the terminology, why you now, very often. That's how great sales reps think. Why should I reach out to this person? Why would they be interested in my service? And why would they be interested in it right now? Account-based marketing, I think you'll be hearing a lot of it. Essentially, it's like spear fishing instead of fishing with a net. So it's all about being very targeted. Now, it was difficult to do this a couple of years ago because there's so much information out there. Do we have time to go read the news on all the companies that we could be reaching out to? No, we don't have time to do that. The bankers don't have time. The sales reps don't have time. So you need technology like DataFox to do this. Here are a few examples of the types of triggers that we capture for you. New funding. So a company raises a funding round, they're probably going to want to spend some money, right? So you should reach out, congratulate them on their funding round. Unfortunately, everybody does this. So this isn't really a great sales trigger because everybody reaches out at the same time. A couple better examples. Management changes. That's the second bullet point for those of you who can't see it in the back of the room. If a company hires somebody, it's a great opportunity to reach out. Congratulations on your new CMO. They're probably looking for new software, new services. It's a great catalyst to reach out. A new office, that usually means the company's growing. Maybe business is going really well. They're looking to procure more services. Layoffs, on the other hand, could also be negative news, right? It depends on why you're reaching out to a company. A banker might want to reach out and say, I see you're downsizing. We could come in and help you cut some more costs, maybe get you acquired. It's just another example of a trigger. Spikes in web traffic, because we know for the 1 million companies in our database what their web traffic looks like, we can tell you, hey, these businesses in your sector, they're getting a lot of traffic. Things are probably going pretty well there. Or conference sponsorship. You look at something like Oracle Open World or Dreamforce, the companies that have big booths there are spending a lot of money. Things are probably going pretty well there. So again, it's just, this is all like, okay, great. How am I going to keep track of all this across all the companies that I care about? Again, that's where our technology would come in and keep track of all that for you. Now, let me give you an example of account-based marketing. So everything I just talked about done poorly. I mentioned that at a funding event, the whole world reaches out to a company. I'll show you what it was like when we were on the other side of the table. We raised a funding round earlier this year, and we announced it July 22nd. On July 22nd, 23rd, 24th, and the 4 days after that, I got at least 100 sales emails because people were looking at Crunchbase, people were looking at the newsletters that go out about funding rounds. And so a lot of sales reps, they reach out, they say, congratulations on the funding round. Again, it's too obvious, but it's probably hard for you to see here, but the column chart here is the number of emails that went out each of those 7 days. So there were 12 emails on day 1, 24 sales emails sent to me on day 2, and then there was a long tail after that. What types of services? 12 recruiters reached out to me saying, hey, congratulations, we can help you hire more people. 8 software as a services vendors. A couple companies said, congratulations on your funding round. We'd also like to invest. They were offering funding. 409A valuations, kind of like accounting services. People saying they had outsourced engineering talent to offer, real estate, and other sales. So just a lot of people selling their services to us. Now, again, I'll describe what's up on the slide here because I imagine it's a little hard to see. They reached out the worst week of the year because we were super busy that week. We had just made this announcement, and of course we were running around trying to deal with inbound customers and perhaps interest from the press. But this is not the week that we're going to go spend a bunch of money, procure a bunch of services, right? So we had actually raised our round in May. We moved into a new office in June. We bought a bunch of services in June and early July. And then when we announced it in late July, that's when everyone reached out. It was too late. So I don't know if you guys are familiar with Wayne Gretzky. I'm not really. I just heard about it a couple times. But he's a famous hockey player who said, hey, I don't skate to where the puck is now. I skate to where it's going to be. So my point with all of this is when a company says it's raised money, you're too late. You got to find the leading indicators of a company doing well. All those other things I talked about, like opening new offices, hiring great people, etc. What you see here is an example of an alert you would get from DataFox. So it says that 5 months ago, this company announced its funding round. But a month before that, there was a news article that said they had named a new CEO. So that's a great time to reach out. Congratulations on the new hire. That was probably right around the time that they were finalizing their funding round. So that's the kind of information you want to get. A lot of people, they have Google alerts for stuff like this, but we all know Google alerts are pretty noisy, so it's not a very well-honed technology. So again, that's where we come in. So into the hopefully more interesting part of the presentation today. Now, I've only been at this for 2.5 years, right? Before this, I was just a financial analyst, so I wouldn't take this as wisdom as much as just a couple of big mistakes I made where I'd love to share with you what I would do differently this time. So first, I'll talk a little bit about the funding rounds we raised. We raised 2 rounds of funding. The first was a seed round, and the second was a Series Seed or a Series A. I'll explain it in a second. The first round was a $2 million convertible note, which is pretty typical for startups when they're just getting started. They raise a convertible note. And it was led by Google Ventures, and there were a lot of angels involved in the round. When we raised this seed funding, we had very little to show. We felt like we had already done a lot of work, but we had a pretty rough prototype. We were just the 4 co-founders. There wasn't really much there yet. The reason we raised the round, though, is because we just sold people on the team and the market opportunity. And I noticed when we raised our later round that there's a huge difference between raising your first and second rounds. Your first round, it's all about selling the sizzle. We have the team that can do this in a big market opportunity. Your second round, people actually want to see the proof in the pudding. They actually want to see that you've got product market fit and traction. The other thing I noticed was that by the time we needed to raise our second round, it was actually not that much work, because I think one thing we had accidentally done well was we had kept our seed investors very well informed. I sent a monthly email to our seed investors saying, this is what went well, this is what hasn't gone well, this is how our plans have changed, this is where we need help. And so before we really needed the money, one of our seed investors said, hey, I see you guys are onto something here. We'd love to lead your Series A. So my lesson there is, thank God I kept those investors very, very well informed, because that saves months of running around convincing new people to invest in your company. If you can get a fund or a deep-pocketed angel to say, look, I've done a year and a half of diligence on these folks, they're onto something, that's going to make raising the rest of the round a lot easier. I also note here on the slide that it's important to find the right partners and make it easy for them to help you. A lot of our best opportunities, our best hires, our biggest deals, partnerships, future funding, it's all been through an introduction from our investors. So I'm glad we had a pretty big roster of seed investors. There were about 15 investors in total. But the mistake I made early on was I'd send my monthly update and I'd say, can you help us with hiring and finding customers? These investors are super busy. You got to make it a lot easier for them. You got to do some of the legwork yourself. So what some of them instilled in me was the notion that I had to reach out to a specific investor, say, I see on LinkedIn you're connected to these 5 machine learning engineers at Berkeley. Are any of those folks that you would be comfortable introducing me to? Now that's something that an investor can actually act on. So you got to make it very easy for folks. Perhaps one of my biggest time expenditures as CEO of a startup is on cultural stuff, on HR stuff. I didn't realize this was going to happen because I hadn't done it before, but this is where I'm now spending 30 to 40% of my time. And oftentimes when I make a decision, there's a trade-off between instilling process and allowing for chaos. Why does a startup have an opportunity to disrupt massive companies? Because it's faster, more nimble. Why is a startup faster and more nimble? Because its employees, its teammates can act with autonomy. They're super quick. They can take bigger risks, whether it's taking more risk and changing something in the sale process, or especially with software companies, just deploying a feature. Software improvements come very quickly in a startup, where bigger companies, they just can't make those changes as quickly. However, I came from Goldman, a place where everything is processed. So my instinct was usually to put a lot of process in place. And so there was a bit of a trade-off there. Now, there are certain things where I learned we do need process. For example, in our interviews, my teammates were walking into an interview and then just coming up with questions on the spot. Like, what's your background? And tell me more about that. And, what's a company that you admire? And so we'd walk out with very, very poor signal, sometimes even false positives or false negatives. So this is where it was very helpful to instill process. We have a bank of 200 interview questions. For each position, we know the 10 criteria that actually matter for the job. And so we can give somebody the 10 questions that they should ask, or maybe they pick a few of them. So that tension's been interesting to kind of figure out. Myself and my 3 co-founders, we do weekly one-on-ones. So we catch up with each person on the team, give them feedback, get feedback from them, and that's been very helpful as well. I think I need to move along here. No? Yep. So yes, move along. Okay, I'll wrap it up. No. Yeah, last slide then. I'd say two other specific things that I picked up along the way. One, early on we hired a PR firm. I thought, obviously, we need a PR firm to get us written up in the Wall Street Journal. Big mistake, because we were a very small fish. They aren't going to email the Wall Street Journal 15 times saying, you got to write about this guy. No, but I will follow up 15 times. So PR, you got to do yourself. And then secondly, sending monthly updates. If you're sending a monthly investor email anyways, take that email, pull out all the confidential stuff, and send that to your list of 100 or 150 folks you want to keep posted. Potential recruits, potential future investors. You don't have time to reach out to everybody, so it's a great way to keep people posted. And a couple of our best hires, they've been responses to a 4th or 5th email where they've gone, hey, looks like things are going great. Would love to catch up sometime. That's it. DataFox.co if you want to check it out, and thank you for having me.